Good afternoon and welcome to Bulls, Bears, and the Bell. This is your shortcut, really, to getting under the skin of what's happening in the financial world. Today, we are doing a deep dive into August 29th, 2025. It was, well, a fascinating day, wasn't it? Kind of perplexing at times for investors. And our mission, as always, is simple. Cut through all that noise. We want to pull out the most important bits of knowledge from the day's market analysis, help you really grasp what was shaping decisions, what was driving the moves on that specific date. We're definitely going beyond just the headlines here.
Oh, absolutely. And August 29th gave us a lot to talk about. We saw a significant pullback, didn't we, from those recent all-time highs. And it was driven by this mix of really crucial economic data releases and just this palpable sense of caution among investors, especially, the long holiday weekend looming, the reports that dropped the PCE inflation data, the Michigan Consumer Sentiment looked at together. They painted a really complex picture, honestly, somewhat contradictory about where the U.S. economy was heading, left investors with a lot to chew on, a real need to maybe reassess things.
Definitely. And when you look at what really fueled that negativity, it sort of boiled down to two main things, right? Inflation, specifically that PCE report everyone watches, and then maybe even more of a surprise, that sharp downturn in how consumers were feeling. Those seem to be the twin engines pushing the market down that day.
Precisely. And if you take a step back, these reports, they created this challenging backdrop. It wasn't shouted from the rooftops, but there were these subtle hints, these distinct whispers of potential stagflationary concerns. That nasty mix of slowing growth and sticky inflation. That's arguably the toughest spot for the Fed, for any central bank to be in. But what's really fascinating, this is the core tension, I think, is that despite these worries bubbling up, the market itself seemed determined to cling to its hopes for rate cuts soon. That expectation was just deeply baked in. So that sets up the whole dynamic we're exploring today, this real push and pull, the market's desire for easier money versus the, often grimmer reality the data we're showing. A proper tug of war.
Okay, so let's start painting that broad picture of the 29th. What we saw was, a pretty significant retreat, U.S. stocks pulling back from those record highs. It wasn't just a little wobble, it felt quite deliberate. And the tech sector particularly took a hit. You could almost feel the caution in the trading, that risk-off stance people talk about, especially right before the Labor Day weekend. It felt like managers were maybe squaring up their books, taking some risk off the table before a few days of potential quiet, or maybe not so quiet news.
That's a very good description, and it's so important for you listening to remember the context here, because even with that daily dip, both the S&P 500 and the Dow, they still managed to lock in their fourth straight month of gains for August. That's a crucial point. One bad day didn't undo the underlying strength, that positive momentum built up over the medium term. It wasn't a market falling apart. It was more like, as you said, a calculated pause, maybe some profit taking after a really strong run. It just highlights why you can't get totally fixated on one day's action without seeing that bigger trend.
Okay, right. Let's unpack that further then. What were the specific reports that landed that morning and caused such a stir? The ones that pushed the market into that cautious mode. We've touched on them, but let's name them clearly and think about their immediate punch.
Yeah, the main drivers were two key economic releases that morning. They definitely grabbed attention. First up, the July Personal Consumption Expenditures, or PCE, inflation report. Now, this one's critical because it's the Federal Reserve's absolutely preferred gauge of inflation. It's the one they watch like hawks. And second, we got the University of Michigan's Consumer Sentiment Index for August. And together, they painted that complex, maybe even contradictory picture, forced investors to really think.
And the market's immediate reaction was pretty telling, wasn't it? You saw this clear split. Some companies, almost swimming against the tide, actually posted gains, probably had their own strong news driving them. But the high flyers, those high valuation tech stocks, the AI names that have been so hot, they faced some serious selling pressure. It really felt like a day to cash in some chips on those winners. Specifically, the Dow Jones, it held up relatively well, down maybe 0.3%, but the S&P 500 dropped more like 0.6, 0.7%. And the NASDAQ, the tech-heavy one, naturally, it led the way down, falling a chunkier 1.25%. That gap between the Dow and the NASDAQ, it really shows you where the pain was concentrated, doesn't it?
You've nailed it. That pattern, it strongly suggests investors were actively reassessing risk, taking profits, especially from tech, as they headed into the holiday and tried to figure out what this new data meant. This wasn't just random selling. It felt like a considered response to new information. a need to reevaluate what was sustainable after such big gains. The market was basically signaling, okay, uncertainty's up, let's be more selective. And that really sets us up for the deeper dive into why this happened. It hints at these broader economic anxieties just starting to surface.
Okay, so let's dissect that first big piece, the July PCE inflation report. Now, looking just at the headline numbers, they seemed okay, almost calming even. The main PCE price index, the Fed's favorite, came in at 2.6% year over year. That was exactly the same as June and bang in line with what economists were predicting. And month over month, just a small 0.2% rise. So, based purely on those top figures, you might think, great news. Right, enough to keep those Fed rate cut hopes burning bright.
That's exactly the initial take, and it's striking. That inline headline was enough for many to keep the dovish narrative alive. The belief the Fed would cut rates. Traders, they're often conditioned to react fast to those main numbers, and they did. They kept pricing in a really high chance, something like 87% probability of a 25 basis point cut at the Fed's September meeting. So the market essentially looked at the headline and thought, okay, no immediate roadblock here. The path to cuts is still open. It was almost a sigh of relief for those banking on the Fed easing up soon. However, and this is always the case, isn't it? The devil's in the details. This is where the real nuance and, frankly, the real concern for the Fed starts to emerge. While the headline PCE seems fine, the underlying stuff, when you strip out food and energy, the core PCE, that told a much more worrying story, especially for careful investors and definitely for the Fed. Core PCE gives us a clearer view of those persistent inflation trends. And what did we see? It rose 2.9% year over year. That was actually an acceleration from 2.8% in June, and it hit its highest level since February.
But even more critically, the monthly core increase was 0.3%. That marked the third month in a row that core number had ticked higher. So this isn't just sticky anymore. It suggests underlying inflation isn't just hanging around. It might actually be picking up speed again. That's a very different and much more problematic signal than the calm headline suggested.
Okay, so what does that mean then? We've got this inline headline, but underneath, a core that's sticky and maybe even re-accelerating. That sounds like a major paradox. It's like the market's reading one page and the Fed's reading a completely different, much scarier chapter. How do you square that circle?
It is a major paradox, and it perfectly captures the tension in the market right now. The OK headline, let the release, the dovish hopes, persist. The belief that a September cut was still likely. It provided enough cover for market optimism. But that accelerating core number, that's inherently hawkish. It's a flashing light telling the Fed, hey, you can't relax about hitting that 2% inflation target. It really hammers home the point, the so-called last mile of getting inflation all the way back down. It's proving incredibly difficult, maybe even elusive right now. And that stickiness just makes the Fed's job incredibly complicated. Think about their dilemma. A rate cut in September, usually, that would be framed as getting ahead of a potentially weakening job market, right? Being preemptive. But cutting rates when core inflation is actively moving away from your target, maybe even speeding up, that's a really delicate, frankly risky move. It could easily look like a policy mistake. It could reignite inflation expectations, undermine public confidence, basically undo months of painful work. That's the tightrope they're walking, balancing growth support against price control.
Keeps them up at night, I bet.
Mm-hmm. And beyond just the price numbers in that PCE report, was there anything else adding fuel to the fire? What about consumer spending itself? Was that slowing down, giving the Fed some breathing room, or was it still adding pressure?
That's a really crucial question. And the answer, maybe surprisingly, actually added to the inflation worries. Because in the very same report, consumer spending looked robust. It rose a strong 0.5% from June to July. Personal income was up to a healthy 0.4%. Now, normally, strong spending is good news for growth, right? People earning, people spending. But
And that uncertainty justifies pulling back on risk now, especially in sectors whose value depends so much on future growth and low borrowing costs. It suggests people are looking beyond the next meeting, seeing potential for longer-term rate uncertainty, and demanding a higher price for taking on risk.
Right. Okay, so we've picked apart the inflation report, mixed signals, worrying core. Now let's pivot to that second big report from August 29th. The University of Michigan's Consumer Sentiment Index for August. This one, well, it seemed like a much clearer negative surprise, didn't it? The index got revised down quite sharply to 58.2. That's a big drop from 61.7 in July. It's lowest in 3 months and definitely below what analysts expected. And here's where it gets really interesting for you listening. It wasn't just a small dip. It was the first fall in sentiment in 4 months. And crucially, the weakness was incredibly widespread across the board.
You've hit the key word there, broad-based.
That's absolutely critical because it tells us the downturn in confidence wasn't just, say, lower-income households feeling the pinch or older people worried about savings. No, this weakness showed up across all the major groups: age, income, even whether people own stocks or not. That kind of widespread fall suggests something more fundamental is shifting in how people feel about the economy. It's not just a localized issue. It's a pervasive sense of growing anxiety. And crucially, the report itself didn't leave much doubt about the cause. The commentary explicitly pointed to heightened concerns about high prices as the main reason for the decline. It wasn't some vague economic worry. It was the direct, everyday impact of inflation biting hard. And you saw that reflected in the details, too. The sub-index measuring how people feel about their current economic situation. That slumped quite a bit, down to 61.7 from 68.0. And maybe even more revealing, people's view on whether it's a good time to buy big-ticket items, cars, appliances, things like that, hit a one-year low. That strongly suggests high prices are really starting to make people put off major purchases.
A warning sign for future spending. Plus, the index looking at future expectations also dipped, signaling rising pessimism about where the economy and their own finances are headed.
So, thinking about the Fed again, the central bankers watching all this, what's the most concerning part of the sentiment report for them? Is it just the headline drop, or is there something specific in there that would really set off alarm bells?
That's a great question. For the Fed, while the overall drop is concerning, the absolute critical element, the thing that likely caused the most discomfort, was how consumers' own expectations about future inflation shifted. And unfortunately, as you hinted, they moved in the wrong direction. Year-ahead inflation expectations, they jumped up to 4.8% from 4.5% just the month before. And maybe even more worrying for the long term, those 5 to 10-year expectations, they nudged up to 3.5% from 3.4%. Look, the significance of this can't really be overstated. Keeping long-term inflation expectations anchored, meaning people trust inflation, will eventually return to target. That's a cornerstone of modern central banking. If people start believing inflation will stay high indefinitely, they demand higher wages, businesses feel okay raising prices, and you get this self-fulfilling prophecy that becomes incredibly hard for the Fed to break. Any sign those long-term expectations are slipping their anchor, that is a major concern. It suggests the Fed might be losing control of the narrative and potentially control of inflation itself.
It's genuinely a central banker's nightmare scenario because it can unravel years of hard work.
Wow. Okay, but this creates a really stark contradiction, doesn't it? We just heard from the PCE report that actual consumer spending back in July was pretty strong, robust even. Yet here we have August sentiment absolutely plummeting, and people are explicitly saying it's because of high prices. What gives? How do we make sense of those two seemingly opposite signals? It feels like consumers are saying one thing and doing another.
That divergence is absolutely crucial, and it's probably the key insight from the day's data dump. You have to remember the timing. The July PCE data is backward-looking. It tells us what actually happened in July. People were still spending, maybe helped by wage gains, maybe dipping into savings. It's a snapshot of past behavior. The August Michigan Sentiment Survey, though, that's forward-looking. It measures how people are feeling now about the future, their intentions. So it revealed that even though they were spending in July, their confidence about their financial future is now eroding rapidly. And it's because of the relentless pressure, high prices they're facing every single day. They might have managed to spend last month, but they're looking ahead and feeling profoundly worried. They're tightening their belts psychologically, even if not fully physically yet. And if you connect this to the bigger economic picture, this kind of split, strong, past spending, weak future sentiment is a pretty classic late cycle signal. It often comes before a real pullback in discretionary spending, as households start to feel the strain and shift focus to saving or paying down debt. They get cautious. So while the PCE showed past resilience, the Michigan report was a powerful warning flare about whether that spending could actually last. And that's why financial markets, which always try to look ahead, seem to give more weight to the negative, forward-looking sentiment report than the backward-looking spending data. It directly challenged the story of strong corporate earnings growth that had underpinned so much of the market rally. If consumers stop spending, where does profit growth come from? That doubt significantly fueled the risk-off mood.
Okay, so putting these pieces together, the sticky core inflation, the crashing consumer confidence, let's circle back to how the market actually performed on the day. We mentioned the overall retreat, but let's nail down those closing numbers for the main U.S. indices again. The S&P 500 finished at 6,454.48. That was down 0.73%. The Dow Jones Industrial Average closed at 45,496.86, holding up better, down just 0.31%. But the Nasdaq Composite, the tech benchmark, really felt the brunt, closing at 23,407.20, down a much more noticeable 1.25%. You can just see it so clearly in those numbers. The sell-off was really centered on technology.
That's right. And again, perspective is key for you listening. Despite that specific day's losses, remember both the S&P and the Dow still ended August, up for the fourth month running. So while the day felt negative, unsettling even, it didn't completely derail the positive trend we'd seen over the medium term. It was maybe more of a rebalancing, but definitely one sending a message about those emerging risks we've discussed. Now, if we slice into the S&P 500 by sector, you see the divergence really clearly, and it lines up perfectly with the day's themes. Information technology was, without a doubt, the biggest loser, down a hefty 1.7%. And that was driven by weakness right across the board: chip makers, software companies, other high-valuation tech names. These are exactly the companies most sensitive to changing interest rate views and any worries about future growth. Why? Because their valuations are often built on earnings expected far out in the future, and higher interest rates make those future earnings worth less today. It's simple discount math biting hard.
Yeah, that makes sense. And as tech took that kind of hit, it stands to reason that maybe some of the more defensive parts of the market, like healthcare perhaps, showed a bit more resilience, kind of like investors seeking shelter, trying to offset some of those bigger tech losses.
Exactly right. Investors often rotate into sectors seen as less tied to the economic cycle during uncertain times, those defensive plays. And interestingly, this single-day performance was quite a pivot from the trend over the previous 12 months. Over that longer period, it was actually the cyclical sectors, think financials, up over 26%, consumer discretionary, up nearly 22%, that had been leading. Those sectors thrive when the economy's strong and people are spending. That was the story for much of the year. But over that same 12 months, energy was down over 7%, healthcare down nearly 5%. They'd underperformed significantly. So seeing healthcare hold up better on a down day like August 29th, while tech and cyclicals got hit. It just shows how quickly market leadership and preferences can shift when new data changes the perception of risk.
It's definitely not just stocks reacting, though, is it? What about the other corners of the financial markets? Bonds, the dollar, volatility, were they telling a similar story of caution and uncertainty?
That's a really important point. The reaction wasn't just in stocks. You're right, the caution was echoed elsewhere, painting this complex picture of investor unease. Let's look at Treasury yields first. They sent a particularly nuanced signal, almost conflicting in a way. The yield on the benchmark 10-year Treasury note, often seen as reflecting long-term growth and inflation views, it actually ticked up slightly, finishing around 4.22%. But the yield on the 2-year Treasury note, which is usually much more sensitive to what the Fed might do in the near term, it actually slipped down to 3.62%. Now, that divergence is fascinating, the falling 2-year yield. That confirms the bond market was still heavily betting on a Fed rate cut soon, aligning with that 87% probability we talked about, saying, yeah, we think the Fed's going to ease. But the stable to rising 10-year yield, that suggests bond investors still had lingering worries about inflation staying high over the longer haul. Or maybe they feared the Fed's cuts wouldn't be enough to stop a bigger economic slowdown later on, leading to lower growth for longer.
Either way, it signals this deep uncertainty about the long-term path, even if a short-term cut was expected. A really complex message from the bond market. Then you look at the U.S. dollar. The dollar index, the DXY, traded higher, pushing towards 98.21. A stronger dollar often signals a risk-off mood. Global investors, when they get nervous, tend to flock to the perceived safety and liquidity of U.S. assets. The dollar acts like a safe harbor. So its rise reinforced that cautious tone. And finally, reflecting that rising anxiety, the SIBO volatility index, the VIX, the market's fear gauge, it ticked higher throughout the day, closing above 15. That just confirms investors were getting more nervous, expecting bigger price swings ahead, all pieces pointing towards increased caution.
Okay, so even on a day where the main indices were down and caution was the word, some individual companies actually managed to buck the trend and soar. Remarkable strength, really. Who were these standout performers, and what was it about them that let them defy that negative mood? Was there a common thread?
Yeah, it's fascinating, isn't it? A number of companies delivered really impressive gains. They surged because they had specific positive news strong enough to just overpower the general bloom. And I think the common thread, the takeaway for you listening, is that even when the market's nervous overall, investors will still put money to work in companies showing real, proven operational success and a clear path forward. Strong fundamentals, clear advantages, they still get rewarded. Take Petco Health and Wellness ticker. Woof, it jumped about 22.5%. Huge move. Why? They reported quarterly earnings that smashed estimates and, really importantly, they raised their financial outlook for the whole year. That's a clear sign the business is healthy and confident. Similarly, Autodesk, the software firm, ADSK, climbed over 8%. Same story. Beat earnings and revenue expectations, raise guidance. Signals confidence. And in the fintech space, Affirm Holdings, AFRM, rose nearly 11%. Their revenue beat expectations by a massive 33%. Just shows powerful top-line growth. But maybe one of the most interesting winners was Alibaba, the Chinese tech giant Daba. It soared roughly 13%. And that was driven by a couple of things.
First, strong quarterly results, especially in cloud computing, which got a boost from AI demand. But second, and maybe even more influential, was a separate report that Alibaba has developed a new, more advanced AI chip. That potentially positions them as a serious challenger to U.S. dominance in that critical AI hardware space. Investors got excited about that long-term strategic potential, showing the market still loves innovation, even on a down day. A big strategic move.
Right, so that's the positive side. Conversely, where did the biggest hits come? Where did the market really punish companies? It sounds like this was where investors got incredibly picky, hammering anything that looked remotely speculative or just didn't quite deliver after such a strong market run overall.
That's exactly it. The list of the day's biggest losers was heavily tilted towards tech, especially semiconductors and companies tied into that whole AI ecosystem. The declines seem to be driven by a mix of things. Some disappointing guidance from companies themselves, but also just a broader wave of profit-taking. People locking in gains in a sector that runs so far so fast. Investors were basically saying, okay, let's reevaluate these sky-high valuations. For instance, Marvell Technology, the chip maker, MRVL. It was one of the worst performers in the S&P 500, plunging almost 19%. Ouch. That happened after their third quarter revenue forecast came in below what Wall Street expected. And that kind of miss, especially in semis, sends ripples of concern. Worries about cooling demand for key components casts a shadow. Dell Technologies, DEL, also slid sharply, down nearly 9%. Now, they actually reported decent Q2 revenue, strong demand for AI servers. But the stock got punished anyway. Why? Commentary about pressure on profit margins, ongoing weakness in the traditional PC market, and crucially, their earnings per share guidance for Q3 missed the mark. It shows how even good news can get trumped by worries about the outlook or specific metrics. And the negativity around Marvell and Dell seemed to contribute to that broader sell-off in AI leaders as people took profits. NVDA, the undisputed champ, fell about 3.4%. That continued a recent slide, maybe also linked to their earlier data center revenue miss. Other big tech names fell too. Oracle, ORCL, down over 6%. And importantly, it wasn't just tech feeling the pain. Look at Caterpillar, CAT, the industrial giant, lost over 4%. Why? They issued a warning that U.S. tariffs could significantly hit their full-year profit margins. That's a really concrete example of how geopolitics, trade tensions, supply chain costs, how they can directly bite into company profits, adding another layer of risk beyond just interest rates and consumer sentiment.
Wow. It really feels like the market just became incredibly discerning on that day, rewarding solid fundamentals, clear growth, but really punishing anything that whiffed of speculation or disappointment, especially after the run we'd seen. A definite shift in attitude.
You've summed it up perfectly. The market showed a clear move towards a more cautious, more selective stance. Investors were actively reevaluating valuations, particularly in those high-growth areas, viewed through the lens of this uncertain macroeconomic picture, the sticky inflation, the shaky consumer. It strongly suggests that the era of just buying anything and watching it go up, well, that might be over for now. Fundamental strength, clear guidance, resilient business models, those are likely to be absolutely key going forward. It's become a market that demands proof, not just promises. So as we kind of wrap up this deep dive into August 29th, 2025, it's really clear, isn't it? That single trading session was almost a perfect snapshot of the market's big dilemma as we head into the last part of the year. Investors are trying to navigate this incredibly tricky landscape, caught between, on one hand, this persistent hope that the Fed will step in with rate cuts to prop up a potentially weakening economy, and on the other hand, the stubborn reality of core inflation just staying too high, which severely ties the Fed's hands, limits their ability to actually cut. It's a classic economic tightrope walk.
Absolutely. And as we've dug into today, that sharp fall in consumer sentiment throws a huge new wrench into the works, a really critical new variable in this already delicate balancing act. It casts serious doubt on whether that strong consumer spending, which has been the engine for so much economic growth and corporate profit this year, can actually last. If consumers really do pull back, well, that changes the entire game. So what does this all mean for you listening as we look ahead? Especially with the Labor Day weekend now past, what's the next big thing to watch?
Yeah, with the holiday over, all eyes immediately shift to the next major data point, the August jobs report. That's the next big catalyst that could really swing market sentiment one way or the other. You could see a couple of scenarios play out with pretty different results. If the report comes in weaker than expected, showing the labor market is clearly cooling, that would likely be seen as giving the Fed the green light for that September rate cut we talked about. Could spark a relief rally in stocks. But if the jobs report comes in surprisingly strong, especially when you combine it with that sticky core PCE data, well, that could seriously challenge the whole rate cut narrative. It might force markets to dramatically reprice Fed expectations, push that September cut off the table, and almost certainly lead to a big spike in volatility. Ultimately, this delicate dance between a cooling job market and stubborn inflation, that's going to be the defining theme for investors in the coming weeks, no doubt about it.
Okay, so as you reflect on everything we've discussed today, here's a final provocative thought for you to mull over.
Given how discerning the market seems to be getting about fundamental strength and facing this ongoing challenge of high core inflation, how might a sustained period of these conditions force investors to completely rethink what a safe investment or even a growth investment really looks like in the long run? Are we potentially moving beyond just defaulting to tech names? Could we see a renewed focus on assets or sectors that genuinely hold up better in a world with maybe stickier inflation and slower growth, perhaps areas we haven't really thought of as growth for quite some time? Something to consider.
Thank you so much for joining us for this deep dive into the market action of August 29th, unpacking bulls, bears, and the bell. We really hope this has given you a clearer, maybe more nuanced perspective on the fascinating and, yeah, sometimes contradictory forces shaping our financial world. We look forward to you joining us again as soon as we continue to unpack the markets.